Hello everyone and welcome to another video on margin trading with Manveer. In our previous videos, you learned the basics of margin trading and the power of leverage. I know it can be exciting to think about how this strategy can amplify your gains in the stock market. But as with any financial strategy, margin trading comes with its own set of risks and rewards. Today we are exploring the pros and cons of margin trading to help you make informed decisions. Let's dive in. Let's start with the pros. The first and perhaps the most attractive advantage of margin trading is increased buying power. With margin trading, you can buy more stocks than you could with just your funds. This opens the door to bigger investment opportunities for you. Next, there's the leverage profit potential. Because you can control a larger amount of stocks, any increase in stock price means your potential profit could be significantly higher than if you were using only your own money. Margin trading also allows for short selling opportunities. If you believe a stock's price is going to fall, you can borrow shares to sell them at a current higher price, then buying them back at a lower price, profiting from the difference. However, with greater potential comes increased risk. First, one major downside is increased risk exposure. Leverage means you are not just amplifying your gains, losses are also magnified, which can quickly deplete your investment. Second, interest payments add another layer of cost. The funds you borrow aren't free. They come with an interest rate that will continue to accrue as long as you hold your leverage position. Third, potential margin calls are another critical risk. If your account value falls below the maintenance margin requirement, you will need to add more funds or close positions to cover the shortfall, which might force you to make unfavorable trades. Fourth, margin trading can also be an emotional stressor. Watching the market's volatility and knowing each swing could significantly impact your finances can be a heavy burden to bear mentally and emotionally. Fifth and lastly, the very nature of margin trading makes it highly susceptible to market volatility. Economic news, market trends, and unexpected events can all turn a profitable position into a loss very quickly. In conclusion, while margin trading can be a powerful tool to expand your investment strategy, it requires careful consideration and risk management. Always ensure you have a solid understanding and a clear strategy to handle the risks. Thank you for watching. Always think wisely before you leverage. See you in the next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.